Hitesh Oberoi joins us, needs no introduction, CEO of InfoEdge. Hitesh, good morning. Thank you for joining us. I've got lots of questions for you. What should we start with? What we heard from Zomato over the weekend, your job index, or in general, what is happening to Naukri.com and what is happening to your investee companies? I'll give you the option today. As anchors, we normally ask a question, but for a change, let's do it differently. You're old friend, Hitesh, so let's do it differently this time.
No, there's a lot happening. You're absolutely right. April and May, we saw lockdown. Almost all business activity came to a halt in almost every segment, in almost every sector of the economy. June has been a lot better. We saw our own JobSpeak index, which we sort of publish every month, go up by 33%. We were at minus 61% in April and May. In the month of June, we were at minus 44%. Now, what JobSpeak index tracks is mostly, it's more closely linked to revenue than to the activity on the platform. The activities on all our platforms, both 99 Acres and Naukri, and even Shiksha to a large extent, and Jeevan Sathi are almost back to normal. So at least job seekers are back. People who are looking to buy property are back on our platform. Students are back, trying to figure out what college, what course. So at least from an activity standpoint, we are back to maybe 90% of where we were about a year ago. Of course, the situation is a little different in different cities. Emerging markets are growing for us. We are growing 25-30% in emerging markets already. But the big markets, the big cities like Bombay, Delhi, are a little more hit. We are still down 25-30% in these cities because they've probably been more impacted by the lockdown and by COVID. Revenue in Naukri and revenue in all the verticals will follow with a lag. That's how it always works. Businesses are still trying to sort of become comfortable with what's happening. Whether these green shoots actually sort of, whether this momentum which we saw in June sustains and if things become better in July and August, then I'm sure business confidence will also come back. But early days on that one, some green shoots there, and especially in certain sectors like IT and healthcare and pharma and edtech. But in certain other sectors, like travel, tourism, hospitality, auto, things continue to be, maybe 70-80% below where they were last year.
Hitesh, you are a cash-rich company. You have surplus cash in your balance sheet. But you also have plans to raise capital. I mean, that's what I remember reading a couple of days ago. Why are you looking at raising capital when you are a cash-rich company? I mean, why are you planning a QIP?
No, you're absolutely right. We are sitting on 1,500 crores of cash. The Naukri business has a 50% EBITDA margin. So if growth, if business comes back, then Naukri will start making money once again. So as a company, we generate profit. Unlike a lot of other internet companies, we are sitting on tons of cash, but we also see a lot of opportunity going forward. One, from our internal businesses standpoint, we are, like I mentioned, we are in these four verticals: jobs, real estate, matrimony, and education. We see a lot of growth opportunities. We are a clear leader in jobs, but even in jobs, there are many more things we want to do, which will require investment over time. We are studying the blue-collar space, job space. We are looking at getting into recruitment. We already have a play in recruitment automation. We want to scale that up. We are looking at adjacent areas we can enter into. Just a while back, we invested in an HR services company called Great HR. That is an investment. We don't run that company, but we are sort of looking at what we can do in adjacent spaces because ultimately we end up selling to the same companies and to the same HR sort of community. In real estate, we still have a long way to go. We're only getting started. Right now, we mostly play in the residential buy segment. Over time, we would want to get into rentals. We would want to get more deeper into commercial real estate. Even in the residential buy segment, we still have a long way to go. We still have a lot of competition. We need to break away from the rest of the pack, and that will require investment in multiple areas going forward. In matrimony, we are a number 3 player. We are growing the fastest. We've doubled or tripled our volumes in the last couple of years. But we are still number 3. So there is still a long way to go. Now, in all these categories, we can we are looking at multiple things, multiple strategies. We are going to be investing a lot more in our product development and innovation efforts. We are going to be investing a lot more in branding going forward. We are going to be doing a lot more strategic investing in adjacent areas. Like we invested in a real estate analytics company some time back. We invested in 3 education companies in the last year or so. And we are also open to the idea of acquiring companies, doing more M&A in the categories we operate in. Now, if we have to do all this over the next couple of years, then we believe that the money we have right now may not be enough, and therefore the board has sort of told the management team that you're okay. If it's okay if you want to raise more money, and that's what the enabling resolution for the QIP is for.
Okay. So just to get one more follow-up question, Hitesh, because capital allocation is something shareholders always look forward to. I've admired Sanjeev and you that you not destroyed cash. You had cash, and when there was a crazy boom in the startup space, you bought good companies where you've reasonably increased your stakes without going completely haywire with your capital allocation. Now, when you're sharing such a large capital allocation plan, it makes me wonder that, bhai, kya ho raha hai? I've not heard you talk like this. I've got a lot of big plans, increasing stake, advertising, branding.
No. So listen, there is opportunity, and this, you don't do capital raise every year. You raise capital maybe once in 5 years or once in 7 years. So whatever capital we raise will hopefully sort of last us for a long time. And it's not as if we are going to go crazy on M&A. We've never done a large M&A. We acquired IIMJobs some time back. We've done a bunch of strategic investments, 20, 30, 40 crore type of investments in, like I said, in some education companies and some HR services companies. But it's not as if we're going to go ballistic, right? But, to buy any sort of company today, in the internet space, you need at least a couple of $100 million. And that's all we have in the bank, right? And what we don't want to do is risk all the money we have in the bank on an M&A. Right. So if tomorrow there is an opportunity to buy a distressed asset or to buy something which sort of helps us gain more market share or which takes us into an adjacent areas, we should be ready. And that's why this raise at this point in time. And it's not as if, we're going to sort of take this money and sort of it'll be over in a year or so. Normally, if you look at our track record, we maybe raise money once in a few years.
Wanted to take a couple of cues on Zomato, and just wanted to understand how much trouble is Zomato really in, because 2 consecutive years of losses of about almost $300 million, and that's despite revenues doubling last fiscal. How is this sustainable?
You're absolutely right. It's not sustainable, which is why Zomato has been trying to cut burn for a while now. So about a year ago, maybe they were losing $40 million a month, right? Then they brought it down to $20 million a month pre-COVID. They were maybe down to maybe $14, $15, $18 million a month of burn pre-COVID. And of course, April and May were very bad for all the companies, including Zomato and Swiggy and everybody else. But what has happened is that because of COVID, of course, volumes have fallen, so business is down to maybe 50% levels. But this crazy discounting, this crazy sort of spend on customer acquisition, which all these companies were sort of doing till some time back, has gone. So will it come back once the sort of market goes back to normal? I don't know. But right now, nobody's spending crazy amounts of money on customer acquisition. People are trying to fix the supply chain. People are trying to fix a lot of the other issues they have. But they're not spending crazily on customer acquisition. And as a result, what is happening is that companies like Zomato, at least Zomato, which we can speak for, which were losing, Zomato is losing maybe 30, 40 bucks an order till some time back, is now making 30 rupees an order. And which is why EBITDA burn in Zomato is down to maybe a couple of $1 million a month right now.
Sure. Hitesh, correct me if I'm wrong here. According to reports, Alibaba's investment in Zomato was rejected recently. Will you, as an existing investor then, be pumping in more money into the business?
So like I just said, Zomato is now losing a couple of $1 million a month. And so they're very, very comfortable on cash. They have enough money in the bank to, if so this rate of burn sort of continues. In fact, if volumes grow, burn may fall further unless irrational competition comes back. they have enough money to last them for a couple of years. So, and it is not as if there are Chinese money was the only money chasing Zomato. There are a lot of other investors also who are interested in investing in Zomato, and we are speaking to a few of them right now.
Sure. But Hitesh, I mean, restaurants are also innovating, focusing on cloud kitchens now. The past many orders that I've taken, the food has never come from the restaurant but from cloud kitchens. Many don't want to pay a Zomato, a Swiggy, the high commission in that sense. Do you think this entire business model somewhat is under threat in the post-COVID era?
Hold a different opinion. Of course, fine dining is under threat because of COVID. People are not able to go out and dine anymore like they used to. And that actually is probably a big opportunity for all the delivery companies, because people still want to eat out. I mean, they don't want to eat home food all the time. So if people were maybe dining out twice a month or once a month earlier and spending tons of money, because dining out is very, very expensive. On the other hand, delivery is cheap. Right. So for the money you will spend on one sort of, this thing outside, you can order food maybe twice or thrice, if you order in. So my sense is that consumers are still going to want to eat outside food. They don't want to just eat home food all the time. And right now it is unsafe to go out and dine. And therefore, ordering in will probably increase. You'll see it coming back. And that's why actually across the world, there is a renewed interest in food delivery companies, not just in India, but everywhere in the world. And valuations that in many parts of the world are actually going up for delivery companies, because people believe that more and more people will be ordering in rather than eating out going forward.
Sure, fair point. There's Amazon's entry, Swiggy's anyway there. Wanted to understand if the market is big enough for all players to happily coexist.
Well, it depends on, see, what tends to happen is that people have a view on what the market is like. Companies have a view. I lost you for so companies often have a view on what the market is going to be like. So if the view out there is that this is a great market and business can double every 2 years, and in 5 years from now food delivery would be 10x of what it is today, then what tends to happen is you see crazy investment coming in. You see irrational competition. You see people spending tons of money on acquiring customers and wanting to be number one, and so on and so forth. On the other hand, if the players in the market take a more rational view of the market and they say, okay, this is a healthy market, good market, but it's not a market which is going to double every year. We are happy to grow volumes at maybe 30% a year, 40% a year for the next few years. Everybody can coexist, and also make a lot of money, and at the same time provide great customer service as well. Right. So a lot of these things depend on the view companies and investors take of the market. I am hoping that good sense will sort of come back. The market was a little irrational in my view personally for the last few years. I personally don't think, the Indian market is going to explode over the next 2, 3, 4 years. It will be a slow and steady recovery. And if customers and if companies sort of remain rational and they invest appropriately, they can all coexist and also be profitable at the same time.
Okay, Hitesh, on that note, we'd like to let you go. Thank you so much. Great to have you on the show, and we should chat more often and get a sense of what the trends in the industry are.
Thank you.